All right, so it's a very special day because with me I have Siddhartha Bhaiya. Well, I doesn't need any sort of introduction, but there are few people who have joined here for the first time. For their benefit, let me have the privilege of introducing him. Well, Siddharth brings about more than 2 decades of experience on the table, especially on the equity investing, and he had experience working with Reliance Mutual Fund, which was then one of the largest mutual funds in India, managing the largest book of equities along with Madhu Kelaji and Sunil Singhania ji. Those days, I mean, they were the one who started up, and they were instrumental those days. And then, of course, Siddharth joined there and then started handling the funds over there. And then after that, he started his own company, the PMS house, which is called Equitas, a boutique house specialized in mid and small cap, more particularly in small cap, I would say. So they are the one who gets onto the curve in the early stage of their growth curve, especially in the small companies, and prefer to ride through the growth journey, and achieving or witnessing 100x in your lifetime. I would say it's a lifetime achievement, and I'm glad to share that Siddharth has identified few stocks which has grown 100x in 10 years time. So we thought, why not, we'll read his mind today, understand and dwell upon a deep dive more about how does he identify those companies at an early stage of their growth curve, A, and B, also try to understand that many a times we've observed that he's always ahead of others in terms of identifying the cycles as well. There are various cycles which I'm sure all of you know that goes around in the markets, and at times you need to be ahead of others in terms of understanding where things are. And being a contrarian, so it's not about becoming a contrarian, I would say. It's about understanding the rationale behind why you need to be ahead of others. So it's not a pure contrarian approach, I would say. So I'm also would like to take this opportunity to congratulate Siddharth that they're going to complete now almost 10 years. It's been 9.5 years, I believe, with the stellar performance and more than 30% CAGR returns. I repeat, if your portfolio is growing at 26% year on year, then your 1 crore becomes 10 crores in 10th year. And then in 20 years, it becomes 100 crores. And because Siddharth doesn't take a crore rupees, the minimum threshold to enter into Equitas is minimum 10 crores. So those who have committed 10 crores at the beginning of the fund, their valuation, I'm sure, would have grown to more than now 95, 96 crores. Well, I'm not sure the exact number, and today we'll understand more from Siddharth what should be the exact number. So I'm not wasting much time. Over to you, Siddharth. Thank you so much for accepting our request and joining the call.
Thank you. Thanks. Pleasure. It's a real pleasure, Vikas, to be here with you. So when we started out, obviously we did not start out with a 10 crore ticket size, but even then we started out with a minimum 1 crore ticket size. And I just want you to take a guess as to what would be that portfolio that client still remains with us. Any guess on what the value of that portfolio is today?
So the moment it goes beyond 26%, so we are talking about more.
We are at 32%, but
yeah, so
the client has given us money along the way. Okay, and that 1 crore portfolio is today 65 crores.
Yeah, so that's what I say, that the difference becomes almost double.
Right, so he's given us the nearly 15 odd crores over the last 9 years, and that value is today close to 65 odd crores. So we've made a lot of money, and that's our story. See, we work with very few clients, but the kind of we are here not to make AUMs or to garner AUM. We are here to make money for clients, and that's our objective, right? So we onboard very few clients in a year with our ticket size and everything. There's a lot of filtration that happens, and there's a reason for it. We are in the small and mid cap space, so we cannot have a mass market product. We build individual customized portfolio for clients. So to make money, you need to have customized portfolios. To garner AUM, you can run model portfolios. It's very easy to build model portfolios and get money from clients, but I'm not sure whether you can actually make money for clients. So because more than 75% of our AUM is profits that we have made for our clients today. So of the total AUM that we manage today, close to 2,000 crores, only 25% is what the clients have contributed till now. The rest is profits that we have made for them. And when I talk about this This is excluding our fees. So truly, a crore invested with us in 2013 is today close to 12 crores. And I think very few, and it's not just on the Excel sheet. We have clients for whom we have made those kind of, in fact, 8 out of our first 10 clients still continue to remain invested with us. So that's this. I think that's this, and it's essentially because of our multi-bagger approach to investing. Right.
Yeah, so I saw a few updates that there are stocks which has completed 10 years and they're hitting all-time high. So what is that? If you could throw some more lights on that.
Right. So we've, one of our top holdings, right? We've been holding on to that. We bought that stock first time in 2013 at 9 rupees. Yesterday, the stock made a new high at close to 280, 290 rupees, 300 rupees. In fact, it did 300. So it's more than a 30 bagger. We're the second largest shareholders over there. And we've held on to that company. We've added our, increased our exposure over the years. And it's a very high quality company, right? It's when we bought, the market cap was 200 crores. Today, the company has net cash of 500 crores on the balance sheet. And even at 300 rupees, it is at single digit P multiples for next year's earning. So because the whole idea of multi-bagger approach to investing is you invest in companies, you don't invest in stocks. And then you have to trust the management. You have to ride the companies through cycles, through number of years, through ups and downs. And then that is, see, we all think, oh, Rakesh Jhunjhunwala, Titan. But he's held on to Titan since what, 1998? Probably before that. He saw 9/11, he saw global financial crisis. In between, he saw, the COVID pandemic and so many other mini collapses. And that's how it became a multi-bagger. So the first and foremost thing is, if you want to own a multi-bagger, you should have the patience to hold for a number of years.
So the topic here is today, Siddharth, how do we identify these multi-baggers? So what is your rationale? What is your philosophy? How do you select stocks? If you could throw some more lights in detail for our audience, that would be great.
Bro, no, thank you. Thanks, Vikas. So see, there are three pillars to our multi-bagger approach to investing. Okay, first and foremost is value. And my personal belief is that if you build a portfolio of value stocks which are spread across various sectors, then there is very low probability that in the long run you're going to make, not make money in the stock markets. You are definitely going to make money in the stock markets. Even something like a CPSE basket has tripled in the last 2.5, 3 years. And the PSUs have more or less underperformed. And yet you could have tripled your money. But people were busy buying, all the popular names like HDFC Bank and so many other financials which have not done anything over the last 2-3 years. And that's when they became popular. So first and foremost is buy value. Buy value at a significant discount to its intrinsic value. Not just, stock market is a place where stocks guided between 20% of intrinsic value to 500% of intrinsic value. So stocks can go 80% below their intrinsic value. So you have to buy it not just at a discount to intrinsic value, but at a significant discount to intrinsic value, right? And then you have to let the story play out till the time, the valuations get frothy. You could buy a stock, say theoretically whose value is 100. You could buy it at 80 rupees, then see the stock price go to 20 rupees, and then sell it back at 120 rupees, and then see the stock price go to 500 rupees. And you would have missed out the entire multi-bagger journey. Right. So as Ben Graham said, the market is manic depressive, and you have to, buy into those manias and depressions within the market. So clearly, that's the first focus for us, buying value. Second, as I said, is growth. Growth is important, but what matters is future growth. Historical growth has got no relevance, right? Historical growth has got no relevance. 2020, the stocks, 2020, 2021, the stocks that you had to buy were the commodity stocks, because that's where the future growth was, which has happened over the last 2 years. You have to buy future growth. You cannot buy, and typically what happens in the market is people look at historical growth and say, wow, these companies have done so well. And these are the companies which will continue to do well over the next 8 to 10 years. So future growth is important, and growth is something that gets rewarded. As earnings grow, P multiples expand. Right? So a multi-bagger is a combination of earnings growth and P expansion. You need both for that. Right? No, to have a 100 bagger, you cannot have earnings grow up 100x. Very few companies have managed that. So how is it possible? It's possible if the earnings grow at a rate which is higher than what the market expects. And then second is the P expansion. I'll give you an example. We bought Avanti Feeds in 2013. Okay, and at that point in time, we owned close to 4% of the company. The company had a turnover of 300 crores. Its market cap was 90 crores, and their profitability was 30 crores with no debt on the balance sheet. So this was a company which was available at 3 times P multiple. So this was not just a discount, but at a significant discount to intrinsic value. First criteria. Second, if you look at it, if you just open the government of India at that point in time had permitted cultivation of Vannamai shrimps in the country, right?
Yeah.
And that was a big game changer because Vannamai shrimps, the produce can be 4x that of the traditional, black tiger prawns. So there was going to be a huge demand as far as shrimp feed was concerned. And this guy was the only player with more than 50% market share as far as shrimp feed is concerned. So growth in their balance sheet, they said that we are expecting 15 to 20% growth for the next 4 to 5 years. It's another thing that they ended up delivering more than 30% top line growth over that next 5 years. Their top line growth was closer to 40-45% CAGR over that period. So second is the growth came in, and third is a contrarian approach. When we invested in Avanti, I told a lot of my friends that, look, this looks very nice. This is the annual report. This is available at 3 times earnings. And nobody was interested in that company. And then people came and said, oh, all these shrimp feed companies that come with IPOs in 92 and everything, and none of them has ever done well. I said, but look at this company. And then from a 90 crore market,
I think grown by more than 100 times now, as we
yes,
see.
Yes. So from 90 crore, the market cap eventually went to 16,000 crores. And from a 3P multiple, it went to nearly 60-70P multiple. And at 60-70P multiple, everybody was gung-ho about the stock. And we quietly exited the stock, and we haven't since bought the stock. So we've all heard that. We've all said that. We've all heard Buffett say that what is popular on Wall Street seldom makes you money. And yet we want to buy the popular names. So the key is do your research, right? Buy low PE, buy a strong balance sheet, focus on future growth, have a contrarian approach to investing, and I'm sure over a period of time you'll make a lot of money. That's a simple motto to investing.
Sure.
I think because I can't hear you, sorry.
Yeah, can you hear me now?
Yes, I can hear you now.
Yeah. So Siddharth, if you could share your experience especially last 10 years of experience where we saw 2011-12 of bad times, Brexit, etc. And then we saw 2018-19 of series of events like Demon and GST and then RERA and then mid and small cap categorization, which led to almost 60% fall in the portfolios. So how do you suggest two things here? What has been your experience, A, and what suggestion do you have for investors, especially who are investing in mid and small cap segment particularly?
See, to be honest with you, you really have to have a long-term approach to investing. Right. As I said, we've had so many incidences over the last 20 years, right? From 9/11 to the global financial crisis to, the Arab Spring to demonetization to the mid and small cap categorization and the subsequent fall, or even recently with the Russia-Ukraine war. And yet the markets have been higher. So the first and foremost thing is, if you're going to panic when the markets are going to go down, then you should not be in the stock markets, period. Right? There is only one solution to making money in the stock market. It is to invest on a regular basis. I'm still a regular investor in the markets. I still invest every single month into our AIF. Correct? Every single month, whatever salary I get, I will put some money from that into the AIF. That's the only way. Every single month for the last 10 years, we've plowed back our profits or our fee or whatever we've earned back into the stock markets. We have that much belief. We're not dependent upon fee income to run our organization or any of those things. We have a very strong balance sheet. And at an individual level, if you want to have a strong balance sheet, you have to be a very, very regular investor. Anyone who's done a nifty, one mid and small cap space is not place where you should venture out on your own. Let me be honest with you. You have to go through professional and somebody who has done well over a period of time. I compare, we will be completing 10 years because very soon. And right now we're at 32% CAGR. And suppose if you end up with 30% CAGR, I can tell you there's going to be nobody even close to us over the 10-year period. And in the last 10 years, all I've seen is my competition keep on changing every single year. People are only focused on the fund manager who's done well over the last 1 year. Right? And we're not in that 1 year game. We're not in the 3-year game. We want to do well over a longer period of time. We will take calls which are right for the clients. We will not, in the last 4 to 5 years, we've not sold any major, most of our holdings have remained constant. Right? We might have added a few shares, but we've not sold a lot of our holdings. And people's perception has changed. 2020, people said, oh, all the mid and small cap stocks are kachara. And today, 400, 500% higher, nobody's calling them kachara. And probably another 500, 1000% higher, people will say, wow, these are quality names. Right? People's perception, only recently today, I put up a tweet on Century Enka. We have a small, tiny shareholding over there for our clients, right? We bought this stock at 180, 190 rupees or something. It was available at one time EV EBITDA. And nobody wanted to buy it because people were saying NTCF is a dying business. It had more cash. It had nearly 60, 70% of its enterprise value in cash, plus surplus land and, a duopoly business. Fine. Again, as I said, NTCF might be a dying business, but at the end of the day, we are looking at value. And today, all of a sudden, the scenario has changed completely. People are talking about, it being a structural change. I don't think so. It's a structural change. So that's how this is. Buy value, as I said, and sit tight. And hopefully, when people start calling your stock a secular growth story, is probably the time to start exiting.
That was great. On a lighter note, the other thing is, Siddharth, so your minimum threshold is 10 crores, and there are a lot of clients who are in India, and some of them are in Dubai and some outstation, NRI clients, and they keep asking me. So, is there a way that they can participate in your AIF either, or can you throw some more lights on that, if there is any way?
No, so see, we have domestically we have two products. One is a PMS, right, which is meant for where it's a very exclusive, where we build customized portfolios for clients. And the idea over there is not to onboard more than 20 to 25 clients in a year. That would be the max, right? Because we actually do build, we help clients take stakes in companies. So it's not like it's just a portfolio where you're taking money, and no, we actually work very, very closely with this. Second, we have an AIF, right, which is a product which was launched 3 years back. And that's a fund structure where we've kept the minimum ticket size to 3 crores. And the whole idea of setting up a AIF was that people said, look, PMS, the ticket size is much higher, is very high. And honestly, because we do customized portfolios, we can't have smaller ticket size in the PMS. But the AIF is a fantastic product where, any money that subsequently comes into the product actually works for the existing clients. Right. So AIF is a product which I think over a period of time will outgrow our PMS. And it's a wonderful product where I personally believe that you get a little money every month. It's like an SIP into the fund, which happens. And it keeps on, this. Now, very recently, because we've launched an offshore fund as well. So you're talking about NRIs.
Yes.
Right. So that's an opportunity for all our, not just the NRIs, but any global citizen who wants to invest into India. So that's a vehicle that we are going to set up for them. It's a dollar-denominated fund. This is in fact the first fund out of DIFC investing exclusively into the Indian listed equity space. So we chose DIFC over all the other jurisdictions because it offered us a lot of comfort. It took us a lot of effort to set up the fund and a lot of cost, but I think it's a very it's a up and coming jurisdiction, and it'll give prospective clients a lot of comfort. So that's again a fund based. That's similar to the AIF. That's
Yeah. So how
the
does
fund.
it function? If you could throw light, and what would be the minimum threshold out
So,
there?
so the minimum threshold over there is $1 million for the fund. Okay, and it'll work as a fund structure. The fund will be again raising money, as I said, from NRIs, from global citizens, from global family offices, from institutions, and investing it into India and into Indian. So our expertise is Indian stock markets, and the fund is domiciled in DIFC. It is registered with DFSA, that's the Dubai Financial Services Authority, and it is registered in Dubai International Finance Center.
And then you said that it's going to be in dollar term in terms
Yes,
of
it's a dollar
accept.
denominated fund. So all the NRIs, they will have to make the payment. They'll invest in dollars and they'll get their money back in dollars.
Sure. So sorry, I'm asking a couple of questions over there because I kept on receiving a lot of emails and they were all asking these questions. They want me to
Surely,
ask
surely,
these
surely.
questions. So yeah, yeah. So is there an exit load if client puts
No,
money from there?
no, we've never had any entry loads, any exit loads in any of our products, except for AIF where there is a 1 year lock-in. Again, that is for taxation purposes, nothing else. Otherwise, we don't believe in having entry loads, exit loads in any of our products. Our objective
So
is
client
that
can
once we get a client, we want to retain him forever. And there's only one way to retain him by giving them stupendous returns.
true, true, true. So you're saying that essentially you sitting in Delhi or sitting in Dubai or anywhere in the world, if you wish to participate, you can do so.
Yes,
I mean,
yes.
essentially
If you
that's the
want to
beauty of it.
participate with the best fund manager in the best performing markets in the world, we, we are
Yeah,
there.
yeah. So it's there. So that's another beautiful thing that there's a structure, and the structure
Yes,
allows you to accept money like this. So
yes,
if somebody wants to have an access to your expertise, they can decide to come their
yes.
investment.
And
They
we
can
have now
decide.
a full bouquet of products. Right, we have a full
That's
bouquet
what.
of products for domestic people, for our domestic investors, and for our international investors.
Sure. Because of late, what is happening is, a lot of NRI investors have shown a lot of interest to invest
Yes,
in Indian markets, and they feel
yes.
proud to invest in Indian markets. A, B is, of course, I mean, they've gone to various countries for their own official reasons, but then their heart lies back in India, so they prefer to invest back
No,
in
this is
India.
see for the global NRI, India is a market that they understand, right? They understand how our country functions. India is a land of opportunities if you do it right, right? For somebody like us, for me to start 10 years back and to be able to deliver 32% CAGR is because of the honest hard work that has been put in by so many of the promoters of our companies. So we cannot claim credit. The credit lies with the companies. And for our client, the same goes for our clients, right? At the end of the day, they have reposed their trust in us. We are doing the hard work, right? We are doing the research. We are identifying the companies. We are investing in them. So it's a India is a wonderful country to invest in if you have a long term vision. The Indian market itself has been a multi-bagger because the market has gone up 600x in the last 40 years, right? So and
The
then
other,
in
yeah,
at a time like now where you see what's happening in Sri Lanka and Nepal and Pakistan, you truly appreciate how good a country India is. Our
true.
education system, our value systems really do come into play.
And I was so glad to see that when I saw that FIFA going out and sponsoring Olympics, so that gave me more proud feeling that now they are building up the global platform and trying to take this
Yes,
education level to the entire globe. So
yes,
it's really a proud feeling. The other thing is, Siddharth, so, going back to the last decade and when you started off, then you saw a lot of headwind coming on your way, like Brexit 2011-12 was a bad year. Then 13 Modi government came in. Again, then 15-16 was a volatile year. Then Of course, 18, 19, 20, the entire economy got hospitalized and went into ICOs, etc. So you think that last decade perhaps uh, was could be or in line with this decade, or you think that this decade can be better than the lost out decade, I would say, for us in terms of equity
I think
returns?
because that's a very, very interesting question. And, this is the first time I've been asked this question. And I'll tell you, it's a very good question. And the answer is the next decade is going to be far, far, far better than the previous decade. We barely had any earnings growth over the last decade. From 2011 to 2020, we barely witnessed any earnings growth. Nifty CAGRs over the last 9 years was only 11%. Historically, Nifty has averaged 17 to 18%. Right? So the GST collections that you're seeing is actually profit growth for companies. So the profit growth that you're going to see over the next 5 to 7 years is going to really blow you on the upside. Is really going to surprise you on the upside. So I think there's going to be a sectoral rotation within the Nifty as well, right? With your old economy and manufacturing and infrastructure and global commodities coming back, but that is going to be led by strong earnings growth. So
We saw that, yeah, there's this ratio called corporate profit to GDP, which by then used to be, before 10, 11, when you started, used to be at 6.7% to around 7%, which eventually came down to around 2% during the COVID time. Now, what I'm witnessing now is that there is a uptick in terms of
yes.
the earnings, and again going back to 3.2, 3.4 levels now. So you think with this going, is this ratio is this earning overall earnings has the capacity to go back to, if not 7, then at least closer to 5?
See, I think overall, I think the GDP is going to expand and corporate profitability is also going to expand. So clearly, I think overall, the we have to understand what is inflation. Inflation, it is cost to somebody, but it is also profit for somebody else. So profitability for a lot of companies, a lot of sectors is really going to go through the roof. And I personally see that the next 4, 5, 7 years, we're going to see very high growth in corporate profitability.
Yeah, the other thing is, of course, you talked about in various forums, even in the Twitter. So, what I'm asking you is, we see a lot of new age companies now emerging and growing at a faster rates than others. Like, you know, you growing at 15%, EBITDA used to be a big deal because of your capex. Now, 25-30% of growth witnessed by these corporates are a new normal for us.
Correct.
So, what is your take on that?
See, I think these companies have grown, right? Of all the unicorns, let me put it this way, there will be a few. There might be 4 or 5 which might survive and which might do well. But I would say that between 95 to 99% of these companies will eventually vanish or will exist in very small forms of their current this, right? Coming to and a lot of the growth over the last 10 to 12 years has been driven by free money, right? It has been driven by venture capital money, and it has been driven by traditional way of doing business. Vikas was, हम अपना पैसा लगाते हैं, थोड़ा पैसा बैंक से लेते हैं, कुछ सामान खरीदते हैं या कुछ बनाते हैं, उसको बेचते हैं और उसमें प्रॉफिट कमाते हैं. Whereas these companies forgot the word profit. So a lot of these valuations have already corrected, and I think they will correct even more. The bear market is a long-term process. These corrections will happen over the next 5 to 10 years. It will not happen overnight. While these stocks have corrected 50, 60, 70%, they have to correct 90% eventually. Yes, some of them might do well. I don't know which ones will do well. Some of them will be smart, some of them will be shrewd. They will preserve the capital that they have received, and they will grow well. But a majority of them will eventually, not exist in the current form.
Yeah. Two more questions. Other question is, I keep getting this from a lot of investors. They compare PMS with mutual funds and AIF. So you, out of these three, you have two instruments that you're personally managing at your organization. So if you'd like to throw some more lights on the differentiation between these three instruments?
Yeah, I think because very good question again. I think mutual fund is a product which is meant for retail investors, right? And I think if you invest in mutual fund over a period of time, by and large, you will do well. Over there, I would typically again suggest that the best option for people is to put money into Nifty Bs or index funds. I'll be honest with you, a lot of the active fund managers, you look at it, more than 70% of the active fund managers have underperformed their respective benchmarks. So there's too much pressure over there on daily performance and daily NAVs. So it doesn't make any sense. As far as, again, as I said, I really don't want to PMS. We're the only ones, let me put it this way, in the country who run PMS in the spirit in which it should be run. Whereas, what is a PMS? PMS is somebody coming and giving you money and you're saying, okay, I'm going to build a portfolio for you. The difference between a PMS and a fund is fund already has stocks in place and you go and participate in that.
Yeah.
Whereas in PMS, when you technically give money, you're actually telling the fund manager is telling, okay, you give me money, whatever, 50 lakhs, and say, I'll build a portfolio for you. Obviously, but with 50 lakhs and if you have too many clients, you cannot customize portfolios. So you're just buying model portfolio. And if the timing of the client is right, then he stays with the system. If the timing of the client is wrong, then he goes out of the system. So it's got a lot to do with what time of the market the client is coming. With us, because more than 98% of our clients have actually made money with us. So 98% of people who've given us money have made money. That's a very, very high hit ratio. I don't think so anyone else can claim of such a high hit ratio. And particularly given that we've been around for more than 9 years. So when we have clients in our PMS, we actually handhold them through the entire process. Right? Even with an AIF, we have an open-ended AIF, which is where it is open every 15 days. So AIF is a great product. It's all about how you're going to be investing. Even mutual fund can be a great product, provided you stop hugging the benchmarks and actually start focusing on creating value for clients.
Sure. So two things here. One, because you have worked with mutual fund company and then you manage your own PMS. So why I was asking this is because you have better understanding because you have run all three instruments,
Right.
at your level. And the other thing is, I keep getting this question from a lot of investors and I keep answering. You tell me, I said, you give me, well, one should not really look at the outcomes, but you show me one single mutual fund which has delivered 32% CAGR for 10 long years. I'm happy
Correct.
to kind of I'm not saying that mutual fund is good or bad. I'm nobody to say that mutual fund sahi hai or sahi hai. It has really created a wealth for a lot of investors.
Correct.
But when it comes to customizing the portfolio, the real definition of portfolio manager is to give the mandate to the portfolio manager and let him decide. It is a discretion of the portfolio manager to build the portfolio the way he wants to build and
Correct.
then deliver these numbers in the long run.
See, I'll tell you, I'll give you example, right? We bought Avanti, as I told you, at 18 rupees, right? Our last purchase price for Avanti was, say, around 72 rupees or something. The stock had already quadrupled by then. And once the stock quadruples, it's very difficult for you to add on. So we did not add on for our newer clients, but we held on for our existing clients. Just imagine if I would have bought same Avanti at 2,000 rupees and 2,500 if I was following a model portfolio for my existing clients or for my newer clients also, they would have lost money, right? Similarly, we own Nilkamal. We held that stock since 90 rupees. Okay. As a percentage of our global portfolio, it is not even 1%. But for the few clients for whom we have bought, it is a top holding and it is a 30 bagger. Now tell me, it is not within a buy zone and it is not within a sell zone for me. It's not prohibitively expensive, but it does not come at a significant discount to intrinsic value. So the bigger money in the market is made by holding this stock. It is not made by getting in and out of stocks. So for the clients for whom we hold, it has been a fantastic performer for them. So why should we sell it? If it goes to 40p, 50p, and if we feel it is expensive, we'll sell it irrespective of how many clients own it. Similarly, say something like a Century Enka, which we discussed, right? The stock has gone up 4x in the last 1.5 years. There are some clients for whom it has probably now become the top holding. As an overall percentage, it is very low. But because we build customized portfolios, we will actually take a stock call on an individual basis rather than just dumping it at whatever price. We are not going to buy it at 650 rupees or something, because probably it doesn't represent value at this point. It represents value, but I have better stocks to buy.
So a couple of questions. So between your PMS and AIF, you have few common names. Most of them are
Yes.
common. Is it replica or how is it?
No. There are certain common names. There are a lot of stocks which we own PMS which are not there in AIF. Right. The attribution levels are different for the stocks as well. The strategy, the philosophy remains the same, which is always going to be the case with Equitas. Right. See, we're today a professionally run company. It's not about any longer about Siddhartha Bhaiya. We have a very, very strong research team. Right. We have more than five chartered accountants besides me in the research team. We have we have a very highly professional setup. So, and at some point in time, some of these people are going to become fund managers, but the whole idea is the philosophy will remain the same, the ethos will remain the same, the process for stock picking will remain the same. That's not going to change.
So can we deep dive the strategy, the philosophy that you talked about? Is this evolved over a period of time in last 10 years of experience, or it is something it was there in your mind starting up the journey of it?
I wish I had this knowledge 20 years back, right? But no, I think what happened is this is something which has evolved over the last 15, 20, over the last 20 years, and it keeps on improving every single day, right? We have a very, very unique process, right? We spend 2 hours in the office reading newspapers. Every day, everyone comes to the office, 2 hours you read newspapers. Eh, People spend 2 hours a day going through corporate announcements. We'll do our news meetings in the evening because I want people to be very well prepared with that. Most of the places people will do it in the morning, and then it's a very rushed job. We'll spend 1 hour every day discussing the major events. Everything, we have our own set of screeners that we run, and we don't rely on any third party for research. All our research is generated in house. So the process has evolved over a period of time, and it will continue to evolve over a period, going forward as well.
What are the 2 3 things that you look at, Siddharth, when you select company in your portfolio for the benefit of our audience?
No.
Just a broad view, if you don't mind. Yeah.
So I'll tell you what. I'll tell your audience 3 simple hacks to find multi-baggers. First and foremost, and I'm assuming not most of the. So I'll focus on a very simple ratio, which is the P ratio, which most of the people understand. Okay, and let me put it this way: that if you buy a portfolio of stocks which are sub 10 P multiple, so that should be your first criteria. Okay, or if you're looking at say Nifty or some of the larger indices, might probably want to buy stocks which fall in the bottom 20 percentile as far as the P multiple is concerned. And people will say, oh, they'll be full of PSUs, but you're never ever going to build a complete basket of PSUs, right? That would be stupid. That will be foolhardy. You have to invest across sectors. So maybe there is no harm in owning a few PSUs. Look at Mazgaon Dock and some of the PSUs, Bharat Dynamics, which have done so well. So one is build a portfolio of sub 10 P stocks, spread it across sectors. Second is buy industry leaders. Do not, in the name of small and mid caps, don't go and buy any third grade company. You have to buy industry leaders. You have to focus on companies with revenues in excess of 500 crores. You're not going to go wrong if you do your little bit of due diligence. Again, as I said, investing in small and mid caps, or for that matter, even in the markets, on your own is fraught with hazards. So please don't go about directly investing. If we fall ill, we don't take medicines on our own. So what tells us that we're capable enough of identifying stocks in the stock markets itself? It's a full-time profession. First, as I said, sub 10 P multiple. Second is, market leaders. And third is, most important is balance sheet. Right? Look at companies with net cash on the balance sheet. Right? There are a lot of companies out there which fit these 3 criteria even today. And I'm sure you can build, and then gradually building a portfolio is a long term affair, right? So you can do that over the next 10, 15, 20 years. And I'm sure you'll do well over a period of time.
Sure. Thank you. Thank you so much. Siddharth, there are two lobbies, I would say. So one belongs to Warren Buffett, the other one belongs to Peter Lynch. So one says that, you have to have concentrated portfolio with not more than 15, 16 stocks. And the other one says that, look, I had 150 stocks and I've beaten down the performance of Berkshire Hathaway's. What is your take on that?
So I think, in a way, both approaches were right, and I think I resonate with both Warren Buffett and Peter Lynch. Right, both Buffett's letters to shareholders and Peter Lynch's book, One Upon Wall Street, are two of my all-time favorites. Look, Peter Lynch was managing a very big fund. He was managing the biggest fund at that point in time. And with such a big fund, you have no option but to own 150, 200, 300, whatever number of stocks that he held. I'm pretty sure if he was managing a smaller amount, he would not have held that number of shares. Right? So there's no one
Yeah.
there are multiple ways of making money in the markets. There are multiple ways of investing in the markets. As long as you stay true to your beliefs, to your philosophies, I'm sure Buffett is not responsible when he was running Berkshire and is this. He was not responsible to the wider audience per se. I'm sure if we were to manage a mutual fund, we would manage it differently from the way we manage our PMS. Right? In PMS, our objective is to make money for our clients, absolute money for our clients. Whereas in a mutual fund, your objective is to outperform the indices. There's a big difference. Here we are to make absolute money. If we cannot make money, we have to return money to the clients. So the objectives are different, right? I'm sure if Buffett was managing Fidelity, he would have managed it differently. And if Peter Lynch was running Berkshire Hathaway's prop book and partnership investments, he would have run them differently.
Ultimately what matters is that ultimately you're managing money. What is the kind of mandate you have?
Yes. Yes.
Sure.
I think one thing I must tell you, your line of questioning is really good. I've thoroughly enjoyed, your questions.
No, so this is what I ever since I met you, you gifted me this book, the art
Yes.
of clearly thinking, and that gave me a lot of room to think simple and asking straight
I hope you
questions.
like the book.
Very much, very much, yeah. So, Siddharth, the other thing is, and these are the questions that I keep getting. And when I told my clients that this time I'm going to get Siddharth, they were like, "Oh wow!" So they sent me
No,
few
it's been a
questions
real
in
pleasure.
advance. So credit goes to them. So the other thing is, at one point of time, you have large cap which is doing well. Then you have in our market. So then you have mid cap doing well and small cap doing. Now you picking up one particular segment, so what makes you to say that, look, this is the segment that I want to work on? Why do you want to build your expertise in a particular area and not across the cap?
So, do we have the capability to invest in large caps? Yes, we have. Right. If we can buy the smaller steel companies, obviously we can study JSW and JSPL and Tata Steel as well, and we've been studying them as well. Right. Our idea is to bring alpha to clients. Right. With this clients, the set of clients that we have, we want to be investing in small and mid caps, and our journey is because invest in companies when they are relatively smaller in terms of market capitalization, but sell them when they become large. That's the fun. That's the super fun, right? To identify a Phenolix Cables or an Avanti Feeds or an HEG or a Garware Wall Ropes or Jindal Stainless or Cosmofilms or Polyplex, and see them go from small caps to A group companies. That is what gives you joy. Finding those multi-baggers is what gives you joy. So we every year, every person in Equitas lives and breathes, multi-baggers. So
The other question is the subsequent question on this is, Siddharth, you have been witnessing markets from $0.5 trillion to $2.75 trillion as an economy, as a fund manager in this profession. You saw that happening. Now, India is a country which is growing, so it's emerging. Obviously, the small cap will become large cap. Suppose same Siddharth, 30 years down the line, if he has to restart Equitas, would you prefer to focus again on small cap? By then, I'm assuming that the market cap of India as an economy, the GDP size, which is a balance sheet, will go to 40-50 trillion dollar.
Of course, there will be opportunities, there will be entrepreneurs, right? We started 10 years back. We started with, a 2.5 crore investment. That investment has multiplied by 200x in the last 11 to 12 years. So, as far as entrepreneurship goes, this country, we're going to have entrepreneurs. We're going to have, I'm in search for the next Dhirubhai Ambani or a person who's passionate about his own business. Look at the kind of wealth that Reliance Industries has created, and it was not around 40 years back. So many of the companies, Infosys, HDFC Bank, you name them, and so India is a land of opportunities. I'm sure opportunities will keep on coming up for the next 30, 40 years. The newer sectors, economies keep on progressing, and we'll be there. We'll be there to find the next great company where we can make, where we can back the promoters, where we can back the institution, we can back the organization, where we can find out discrepancies between value and price, and hopefully find multi-baggers.
By any chance, you would be adding any large caps in the portfolio 2, 5, 3, 4, 5 years down the line in AIFs or
Depends.
PMS?
Depends. It'll all depend. If we become, see, you have to adapt with times. If we become much bigger at some point in time, and if some large cap, we have added, large caps in the past as well. We bought HDFC warrants, which made a lot of money for our clients in 2015, 16, 17. It became a five bagger. So we're okay buying large caps at some point in time in the future. We will adapt. We'll adapt, and you know we'll see how
So
the
as a
pitch is.
house, you are flexible. Although your expertise lies in small cap, but as a house, you are open and flexible to sort of understand
See,
and align yourself.
yes, even today, see, if we could identify metals, we knew that Hindalco and Tata Steel were going to do well. If we identified infrastructure, we knew that Larsen and Toubro was going to do well. So it's not that, you know it's large cap investing is in fact easier than small cap investing. Trust me, you can invest in large caps through exceptions. Take out the top 60, 70 companies, weed out the 20 companies, and just then invest in the rest 50. And I'm sure you're going to beat the Nifty.
Sure. So last 2 minutes to go. So any message for our investors that you or suggestion that you would like to make, especially those who invest in small cap segment?
I think the best way to invest in small caps is one, through professional manager. Please don't venture into the space directly on your own, right? If you don't want to go into PMS or an AIF, there are small cap ETFs, right? You can go and invest through those ETFs if you're a small investor, right? Do not look at short-term track records. Focus on the long-term track record for the fund manager. More importantly, don't look at the result. How has the fund manager done over the last 6 months or 1 year? Speak with the fund manager, understand their process, understand why and how they have done well over the period. And most importantly, when you meet a fund manager, ask them about their mistakes. Yeah, and stick with it. Stick with small cap is not everyone wants to come to small cap in a bull market and wants to get out of the small cap space in a bear market.
Oh
Right?
yes.
Everybody was a small cap investor in 2017 and 2020. At the bottom, everyone says small cap is kachra. And look, has the small cap index has rallied nearly 300% over the since then. So it is not that this is a space where you have to be long term. And I'm sure if you're a long term investor, you can make fabulous money. The large caps of tomorrow are there in the small cap space today.
All right. With that, we'd like to conclude the session. Thank you so much,
Thanks a
Siddharthi, for
lot.
taking the time out.
Thanks a lot, because it was a real pleasure talking to you. And I really like your line of questioning. I really enjoyed the session.
Thank you, and thank you, dear participant, for taking the time out from your busy schedule and joining in today. If you have any questions for Siddharth or Equitas, please feel free to write to me, and then I'll ensure that I'll get it answered. I'll reach out to Siddharth and get it answered.
Surely,
Thank
surely.
you so much.
Thank you. Bye.